exchange rate. So you are using mixed method, right? So use a combination of forecasting techniques, technical, fundamental, market-based. Or you can use the two, only technical or technical and the marketing, or technical and the market-based, or you can use fundamental and market-based. So miss forecast is then weighted average of the various forecasts developed. Guidelines for implementing the forecast is that all managers of an MNC should rely on the same exchange rate forecast. That is a difficult one. They say all the managers of the MNC. If one finance manager say that the currency will depreciate and the others say that currency would appreciate, and there is a disagreement between them, and then the forecast is not going to be good. Good forecast means that everybody have come up with the same answer, or with very small, percentage of discrepancy, right? If everybody saying that the currency will appreciate, then you can say that, okay, forecast is that currency will appreciate, and then you make decision. But if half of the managers say that no, it will depreciate, and half of the thing they say it will appreciate, then we say that the market is uncertain. Then you cannot make any specific strategy to cope up with the risk, right? Plus the uncertainty will cost the company as well, because company need to then go for two kinds of transaction. Number one, they will develop strategy if the market will go up, and then they will be making strategy if the market will go down. Both has a cost. If everybody is saying that market will go up, then you just make a transaction, make a scenario for when the market will go up, what I have to do while hedging, and what is the hedging cost. That's it, right? So MNCs may complement their forecast by hiring forecasting services to obtain exchange rate forecast. So nowadays, many big organizations, they are outsourcing their department of forecasting to forex dealers, forex experts, forex analysts, right? So they say that, okay, we are planning that to buy this plant after 2 years. So make arrangement for us, and give us the amounts, say of exchange rates, so that we can plan on the basis of you. And you are credible, we are paying you, right? If their forecasts are not correct, then you will outsource to the other companies. So normally when the big amount is going to be involved, so they don't rely on just one company's forecast, they will ask from two or three companies. For example, they will be asking from UBS, they will be asking from the Goldman Sachs, or they will be asking from the BlackRock company. So these are the biggest names in forecasting and financial analysis companies, right? So here we go. So these are the factors, a summary of the forecasting methods. So, sorry, not the examples of forecasting. So in forecasting, technical forecasting, what factors you consider? You consider recent movement in the currency. So if we are talking about forecasting the Mexican peso, then you will see that what is the recent movement in the peso, and then situation is the peso value declined below specific threshold in the last few weeks. Then based on previous, you forecast that it will continue to fall. What is fundamental forecast? You see what causes or what is the economic growth in Mexico, what is the inflation in Mexico, what is the interest rate in Mexico, and based on the relationship you find out that right now the situation is Mexico interest rates are high and inflation should remain low. So now remember this one, what we talk about in international Fisher effect. If interest rate is high, it means inflation is high. But here they say that interest rate is high, inflation is low. It means the real interest rate is high. So based on that, the peso will appreciate, right? So look at the scenario here. So market-based forecast, you see spot rate and forward rate. Situation is the peso forward rate exhibits a significant discount. That peso has a significant discount, which is attributed that the Mexico has high interest rate. So based on forward rate, it provides a forecast of the future spot rate and peso will decline. So look at the forecasting result of each method, because factors are different, right? Factors are different, right? And let's talk about, we already talked about the market efficiency in somehow. So let's talk about in detail. So we have three kinds of market efficiency. Number one is weak form of efficiency. Number two, semi-strong, and number three, strong form. So what do we mean by weak form? Weak form means the current exchange rate, right? It reflects only information that is available. So the current exchange rate, right? It includes all the historical data and whatsoever is that one. So it means in weak form of efficiency, the technical forecasting will not give you good results. Why? Because historical, all those trends are already included. If you find out that in previous year, in December, the exchange rate go up. So right now, the exchange rate is already gone up. Why? Because the exchange rate forecast already included the past technical analysis. So in weak form of efficiency, the historical analysis or technical analysis will not give you any benefit. Then who can give you benefit here? Fundamental and fundamental. Can I write it here? Fundamental and market-based analysis is going to give you a little bit edge, right? Semi-strong. In semi-strong market, all the public information is already reflected in today's exchange rate. For example, if country's prime minister is stepped down due to the corruption, on that day you would see that exchange rate go down, because all the public information already included. And what happened due to government stability, because government is now unstable, political influence is there, so exchange rate go down. So what happened here? Because, and then you will, if you forecast on that day saying that the president will be stepped down and the currency will go down, it's already included here. So the currency already go down. Then who will give you the benefit? Only if you have private information. And if you receive this news in advance that the country's president will be stepped down in 2 or 3 days, then you can benefit from there, right? Strong form of efficiency is that when all the public and private information is already included in the exchange rate today. So exchange rate right now here, it includes all the information. So for example, if the president is going to be stepped down tomorrow, it's already included here. Currency all a day before depreciates, right? So it means market is very strongly efficient. So we are living in semi-strong stage of market, because still not all the information is available to the public. Some information is asymmetric or private information that is kept by the officials, so they do play with the market. And some analysts, they predict the market based on some private information. We call this tips. So they ask tips from their counterparts. They see the newspaper, they talk to the uh, government departments. Okay, what's going on? They see the news. Okay, what will happen to the court? What they then they ask to the lawyers and judges, and they find out that okay, the judges will likely to make decision to step down the president. Then in advance, they issue to their prime customers that currency will go down. If you hold the currency right now, just sell it. Right? So some analysts are very shrewd through the information, through market analysis, they can give you superior information. Okay, any question? Fabian, Crystal, Nott, Haley, Ping Ping, Nimesh, Marilyn, Janlup, Kathleen?
No, sir.
Okay, so if
No
you
questions,
understand
sir.
all the concept right now, what we have discussed, we are not going into the mathematical stuff here because that is not requirement at this level. So we just skipping that one. So in the book chapter, you will see a lot of stuff over there like standard deviations and all the stuff. So please ignore that one. Okay. So now read the concept checker and give me the answer. So let me read the concept checker. So which of the following forecasting techniques would best represent sole use of today's spot exchange rate of the euro to forecast the euro future exchange rates? Just talk about these three methods extensively. Fabian, can you give me the answer here?